Hello, chart watchers, and welcome to this Tuesday, January 8th, 2019 Market Watchers Live Show with your host, Tom Boley and Erin Swenlin. For those of you joining us for the first time today, welcome to the show, and for our regulars, welcome back. The market is continuing to try to push a bit higher here. We've got the Dow Jones Industrial Average currently up 165 points, the S&P 500 up 11, the NASDAQ up 27, the Russell 2000 at the high of the day right now up 12 points and continuing to perform very well on a relative basis. 10-year Treasury yield continues pushing a bit higher after going down to 2.55% recently. We are now back at 2.71%, up 2.5 basis points today. Volatility continues to drift a bit lower, down 0.26 today to 2114. Leading to the upside, we've got communication services up more than 1%. Real estate almost up 1%. And then you can see energy with a late spike just here recently now up more than 1% as well. Financials lagging today off of the earlier lows, but still down about 0.3%. Transportation stocks also were struggling. They moved back down toward the lows just about 15 minutes ago, but we are seeing a little bit more of a rally now. Transport's trying to break out above its moving averages. We'll see if it holds. Within the financial space, that is weak. At least on the Dow Jones, I think the three worst performers were Goldman Sachs, JP Morgan, and Travelers. So three of the financial stocks. But you can see Goldman Sachs potentially putting in a reversing candle. We'll see how Goldman closes out today's session. All right, Erin, well, the market has its head down right now, continues pushing higher. I saw the S&P got up to 2579 and change, and of course 2581 was the big breakdown, and we were at 2582 when the Fed announced back on December 19th that they were going to continue raising rates in 2019, and that's, of course, was one of the reasons why the market sold off. So we're back at a pretty critical area. We'll see whether or not we can get through. How are you doing today?
I'm doing quite well today. Yeah, the market is really interesting right now, I have to say. I know we've been looking at various levels, and my thought had been that we'd see 2600 as the resistance level, but we're really close to that now. So I'm thinking we might get back above that, but I'm still bear market. I'm just short-term bullish right now.
Yep. Are you short-term bullish on the Anaheim Ducks?
I know. You would have to bring them up. Well, tomorrow we'll be playing the Ottawa Senators, and they're struggling. I'll put it that way. So I think struggling more than we are. So hopefully we'll pull out a win. It's been a really bad dry spell here. We were on a roll, and then boom, not so much anymore.
Well, I just like to stir the pot. And we got Greg Schnell in, and I know he's probably chomping at the bit to talk about his Calgary Flames right now.
Oh, I'm sure.
Hey, our Flames are hot.
Mm-hmm.
That's what I was saying.
Yeah, and my little guy Johnny Goudreau is Johnny Hockey, and he just keeps making it happen. So it's all good.
I teed that one up for you, Greg.
Thank you, Chief. I drove it down the middle.
Well, at least you're not, a one horseman type of team like Edmonton, although they still beat us. So what am I going to say? But the Connor McDavids, that's what we call them here in our house.
Yes, exactly.
Well, they are. He's a thoroughbred in hockey. There's no doubt about it.
Mm-hmm.
Yeah, he is fun to watch. He's exciting. So.
Yep. Well, I know you're joining us today. First of all, thanks for joining us. I know you subbed on Friday of last week, so I appreciate you coming back. You're going to talk about the dollar today. And, of course, the dollar's been, I wrote about it a little bit earlier. It's at a 2-month low. I don't know where you're going with your dollar call, but this will be an interesting discussion for sure.
Mm-hmm.
So, appreciate you coming on, and hang around with us, Greg, because we're going to bring you in about 15 minutes, and I'm sure everybody would like to hear what you think on the dollar.
Okay.
All right. What do we got, Erin?
Well, we've got another Greg coming in tomorrow, Greg Morris. He was unable to join us last time, and now he's feeling better. So we'll be talking to him tomorrow. And Grayson Rose will join us on Thursday, followed by Friday, which is What's Hot, What's Not, with Mary Ellen McGonigal coming in to co-host with you, Tom. Mm-hmm. Today's agenda, Greg's presentation, as Tom said, is going to be all about the dollar. The 10 in 10, our first symbol is going to be Transenterix, TRXC. And our final segment is going to be early warning. And in this case, Tom's going to feed me some stocks. So you'll get to get my my point of view on, on these warnings and see, where we might be going, up or down. All right, Tom, let's get it going. Technical news and headlines.
All right. Well, we really didn't have any economic reports of significance out today. So we'll start with the earnings reports. And in terms of the earnings reports, we have Helen of Troy that came out. They are at they came out with earnings $2.40, $2.40. That's what the market was expecting. AZZ as Inc. 0.59 versus 0.61. So they came in as short of expectations. And also Lindsay Corp. These are not huge companies. They're all a couple of, $1-2 billion companies. That's pretty big. But when you look at some of the others, I mean, we start talking about the Microsofts of the world, and we're talking about hundreds of billions of dollars in market cap. On a relative basis, these are fairly small. But this is just a little taste of earnings season. We'll be getting a lot more of this shortly. But first, before I take a look, I do want to show you that HELE chart because I think that's kind of interesting. Looks like maybe change of character, even though they did beat on the top line and perform okay on the bottom line. And I think they actually raised guidance as well. But first, let's take a look at the 10-year Treasury yield. So here on the 10-year Treasury yield, you can see, and this is a monthly chart, and this is going back 15 years. Now, the reason I'm bringing this up, the last time we had the kind of drop that we've seen recently in the 10-year Treasury yield was probably back in the first half of 2017. And during that period, of course, money was rotating in to both stocks and bonds. We saw a lot of money. We saw the treasuries going higher, yields dropping, and at the same time, we also saw the stock market doing very well in 2017. But we did come down and we held this rising 20-month moving average. This is the 20-month EMA. And if you take a look at where we are right now, we had moved quite a bit below the 20-month EMA, very similar to what we saw back in the summer of 2017. And like back then, we're seeing a reversal and trying to hold this, maybe trying to hold on to this uptrend. So I could probably, annotate this and draw these lines coming across here, the tops and then the bottoms. And I think we'd have a channel that's established. Also, the breakout in 2018 in the yield took out this prior high. And if you notice, we came back down essentially and tested that area. I don't know if you recall, but I know at one point I was talking about the 10-year Treasury yield, and on a worst case basis, getting back to test this double top breakout, which was at 2.60%. And that's what we've done, and we're starting to rally off of it. As long as the 10-year Treasury yield keeps moving higher, that's telling us that money is coming out of treasuries, and normally that money is going to find its way into the stock market. So this reversal right here is certainly helping to spur the S&P 500 higher right now. This is an area I'd keep an eye on because if we see that 10-year Treasury yield start to roll over again and move back down below 2.60%, I think that would probably mean more trouble ahead for the S&P 500. So it'll be a sign at least to keep an eye on. Getting back to the HELE story, earnings, they did beat, as I said, on the top line. They missed on the bottom line, raised guidance, and the stock gapped down. It is now down 13%. But what I am seeing, and maybe what was even what you could see earlier in December, was a clear break of a trend line. The stock had been trending higher since April. It had come in with a couple of really good earnings reports, and it kept moving higher. And then all of a sudden, like the overall market, we saw this big drop in December. The stock did rally a bit before its earnings report. Now with the fairly good news out, I didn't listen to the conference call, but it seemed on the surface like the news was pretty decent, and the stock is selling off. I would be watching to see if it can hold on a close today, this 117, 118 area. We went down to 113 intraday. We reversed off of it, started moving higher. This is something maybe to keep an eye on as we go forward. The other two stocks I mentioned, I'll just pull those up quickly. AZZ, they did miss on their bottom line. It's so funny sometimes when you look at the market because Helen of Troy beats, looks pretty good on the report, and yet the stock is getting hammered to the downside. AZZ comes out, says, I think they may have even warned. I've got a note here. Hold on with me. Yeah, they guided their fiscal year 19 earnings per share lower, and they missed, and the stock is up 7%. So sometimes those who look at it strictly from a fundamental standpoint and don't pay attention to the charts scratch their head. Even even paying attention to the chart, sometimes we have to scratch our head. But anyway, AZZ, not a very good looking chart heading into earnings. We are getting a nice bounce, but we've already fallen about $2.50 from the earlier intraday high. So something to watch to see whether or not the stock continues to weaken into the close. All right, let's go ahead and take a look at, I want to kind of follow up a little bit on what we had talked about yesterday. And when you look at the S&P 500, this is a long-term 50-year weekly chart. Or excuse me, this is a daily chart. When you look at what's been going on here over the last 3 months and this drop, I know when you look back and you say, well, this is what bear markets look like, and therefore, if this is a bear market, shouldn't we be looking for something like this? I would just again say that this was more of a secular bear market where you do tend to see much steeper drops. We saw that in the 2000s. We also saw it back in the 1970s. But when you get these secular bull market runs, this right here, this cyclical bear market that we're in, kind of looks like, here's 98. This was the 98 cyclical bear market. See that little, it looks like just a pullback, and then we move higher. Look at 1991. There's your cyclical bear market. 87, very, very swift crash to the downside, but then we kept going higher. I wouldn't be shocked if we see something similar to this. Now, I'm not sure. I don't think that we're done. We're out of the woods going forward at this point. I think I'd love to see a double bottom, maybe even a little bit of a move below that prior low. But this is something to kind of watch as we go forward. Last thing I want to mention is when we get into an environment like this, I pay much more attention to sentiment and less importance on individual stocks holding support and that sort of thing. And the CPCE, which is the equity only put call ratio, I've had this set up as a 5-day moving average. And the way you can do this down at the bottom is set your chart type to invisible. So it's the data for the equity only put call ratio, but the type of chart is invisible. And I have a 5-day simple moving average. So what is happening is my moving average is really the centerpiece of this chart. The actual data is not shown because it's invisible. Then at the bottom here, I have the S&P 500. But notice these high trips on the 5-day put call ratio, and check out where the S&P 500 is. And you know that every time we get too pessimistic, too many puts being bought, that's when you're probably at a very significant bottom. So I just wanted to point that out, in addition to the volatility index, which has been dropping for the last 10 days. I think starting to get to an area where we may see a bottom in the VIX and a top in the market. We'll have to see. Erin, I know there's a number of upgrades, downgrades, so why don't you take it away?
All righty, let's do that. Yeah, it's been amazing, Tom. There's just been so many upgrades and downgrades coming in lately. I mean, trying to pick which ones are the most interesting actually is getting more and more difficult. So let's take a look at what we did have, though. Like I said, a ton of them coming out. I'm going to go over 5 upgrades and 3 downgrades if I have all of the time to do that. All right, Dollar Tree was upgraded today from a neutral to a buy. What I've been doing on most of these is I'm trying to give you guys some really good ideas of how to come up with your support and resistance when I'm doing these. And it is just so amazing when you start to look at the shorter term support and resistance and then come across and see how many times it's acted as resistance and support all the way across. This is, I think, a pretty important breakout. The only thing I would caution on this particular one with Dollar Tree is we did get this gap, and there is that possibility of an island reversal here. And the only reason I say that is my PMO is starting to get overbought. But overall, I would look for it to rise higher and test this top we had back here. Certainly, we're in the process of covering up this gap that we had all the way back here in March. And that's what I'm expecting to see, at least a way to get up here to this overhead resistance at about 102. Brinker International. This one was upgraded today by Raymond James from market perform to an outperform. And we've got a nice little breakout here above overhead resistance at about $50. That matches up with our tops here in September and in July. And the next level to look at would have certainly be the highs that we saw back here in November and in June. That's where I would expect it to make its move. But we are talking about maybe chasing here. This is pretty parabolic. When you look at this, if I stretch this out, you'd really be able to see that. Those parabolic formations tend to break down very quickly, as we've seen even with the S&P. So you want to be aware of that. But I suspect we're going to see it at least get up to that overhead resistance level before it turns back down. But PMO buy signal and oversold territory, I mean, it's lined up pretty well. But look at this last PMO buy signal in that same area, that same territory. We didn't get that much off of that buy signal. So, and really overall, we ended up traveling mostly sideways here. And then, of course, we did trend lower from that top all the way down to the bottom in October. Global payments, GPN was upgraded from a neutral to a buy. As you can see, PMO buy signal has landed. We're right at overhead resistance, however, and I matched this up with these lows we had back here in the spring and April and May, and then going into the summer at the June low. The next level I would be looking at is overhead resistance at about 115, 116, and that lines up with these tops back here in February and in May, as well as some of these lows back here in July, the lows back here in August. So again, the more touches you get to these support and resistance lines, the better, and it does tell you that you have stronger resistance or support. And in this case, I think this is going to be a difficult level of resistance to get through. Notice that came up today, and as soon as it hit that level, it did turn back down. So we do have the PMO buy signal. We'll be watching this one closely. I would add it to a watch list anyway. Nordstrom was upgraded today by Morgan Stanley from underweight to equal weight. We got a PMO buy signal on this one as well. It's already been in a nice rising trend. It managed to break out above the short-term resistance here at the lows from November and early December. I would look for it to come up here to that $52 level. Again, that one matches up with some tops we had back here in February and March, and back here on these tops in June and July even a little bit. I matched this one up mainly though on this gap, because that's what I'm going to be looking for, is this gap to be covered up. If we can see this momentum continue to the upside, but we still have to leap over that $52 range to even start coming in to cover up that gap that we had. Monster Beverage upgraded today, or I'm sorry, yeah, Monster Beverage was upgraded today. And you can see that we had a nice gap up. We beat out some overhead resistance there in the shorter term, but also in the intermediate term. When you come here again, tops back here in May, lows back here in October, tops here in the short term in December. So we got a nice gap up on that resistance beat, and you can see that the PMO is turned up. We don't quite have that buy signal, but look at the scooter also making a nice move to the upside. I would watch and see if we can't get above this area of shorter term resistance at these tops from October and make a push to test that 200-day EMA. On the best side, we could look for a test of that top at 60, but I can't get that bullish at this point. Molina Healthcare also upgraded today. JP Morgan upgraded from neutral to overweight. As you can see, we're in the process of covering up this gap that we had in mid-December. I would be looking for it to finish covering it, and I would also be watching for a break above resistance at about 130, mainly because of this oversold buy signal coming in on the PMO. All right, 2 downgrades to look at for you. Actually, a couple of them here. We've got Devon Energy. This one was downgraded by Johnson Rice from a buy to accumulate. So we're hitting some very important overhead resistance here at $26. You can see here on those lows in November and in December. So that's going to be this next area of a test. We've got the PMO on a buy signal though, and I think that is healthy. And you can also see that it is now risen above its previous top in oversold territory. So it looks pretty good, but we really need to get above that $26 level. All right, Frontier Communications, Wells Fargo upgraded this one from a market perform to an underperform. We have a nice move to the upside, though, and we have a PMO buy signal in oversold territory. So I think there is actually potential right here to test that 350 level. And of course, with a stock price this low, that could be a pretty healthy return if we can get up to that 350 level. But it looks pretty good here. It's just taking its time on this rise. So one to add as well to your list. And then I did want to look at steel. Let's see, X. Yes, U.S. Steel. This one was also downgraded today by Credit Suisse, outperformed to a neutral. And, you know, we've already gotten above this little $20 level. I think that was important. 5's getting ready to cross above the 20, already on a buy signal in oversold territory. I would look for a move to test the lows over here at about 22.50. And that's all I have for the upgrades and downgrades. Like I said, a huge list here. Bloomin' Brands, Cheesecake Factory, DaVita, Monster Beverage, which we looked at, Nokia, Nucor, Paychex, Steel Dynamics, Union Pacific, Voya, Williams Company, and Nutrien all upgraded today. And as far as downgrades, Baidu, DXC Technology, companies, General Dynamics, Hyatt, JP Morgan, MasterCard, Principal Financial, SunTrust Banks, US Bancorp, and Vodafone all downgraded. And as you can see, a lot of financials in that group that were downgraded. Whew. Okay. All right, Greg, ready to hear all about the dollar.
Okay. Well, you know, that that US Steel chart, the guy gave it a downgrade after it moved from 47 to 12.
Oh, well, that was really helpful, wasn't it?
Thanks for the clue.
Yes, I think we would have picked that one up a little faster here at Market Watchers and Stock Charts.
Exactly. So there's lots to cover. So anyway, we're going to get into the dollar here. I'm going to give you a big picture look at the dollar the last 5 years, kind of zoom in, and then briefly look at the yen and the euro. And really the big idea is, why do you need to trade the US dollar? And I think it's very helpful to make sure that we can time our trades a little better, especially if we're doing ETF investing in foreign countries and that kind of thing. So first of all, here's a picture back to 1973 where we start the dollar. And I've drawn this 97.5 line in on this chart. I don't know about you, but it looks like the most important place on the chart to me. So it has literally been, you know, for years and years and years, a really important level. And we got up to 97.30 here, and then we literally fell away. And these are closing numbers, obviously, because it's a line chart. But the big thing here is noticing this special K trend, that Martin Pring's special K. And what Martin talks about when he talks about this particular indicator is how good it is to draw trend lines, important trend lines on, and where things end up falling over. So this is like an 8 or 9 year trend line. And it's been going down for 2 years. And if we look at the US dollar on a PNF chart, it's in a bear market. I'll try and remember to flip to one of those in just a second here. But looking at this downsloping trend, this looks like it's rolling over right at 0. So 2 weeks ago, it was up at 5. It's already down to 2. And, you know, going below 0 on this indicator is a pretty important distinction. The dollar falls pretty hard when that happens. Down at the bottom, I've used Martin's KST, and we could use the KST or the MACD or whatever, or the PPO. And the reason is because this scale, well, it's a double from the bottom to the top. It's not too severe. It's not like Amazon where it's 15 to 2000 or something like that. So you could pick your indicator, but because I had the special K from Martin on here, I've put the KST as well. It's already in negative territory as a momentum indicator. So big picture on the dollar is we see these two major uptrends, and then we also see these two major downtrends. So we're going to zoom in a little on the next chart, and I'm going to talk specifically more about this kind of pattern that we see. So on the dollar, we had these 10-year trends that were going on, and then we broke out to the upside. And as we made the highs in 2000, we had a big run in the commodities. And when did the commodities top out? When the US dollar bottomed out. And that was a pretty clear point to change direction. But after the financial crisis, commodities and the dollar, well, the dollar fell a little bit, but you can see in here as the dollar rose, the commodities pulled back, and then they went on their final run. And I think metals and materials still pulled, they were up higher, whereas this was really a high related to oil going to $149. So this downtrend in commodities is very scary because we just tried to break through and we couldn't, but we are sitting near support. Now, on the other hand, on the US dollar, you can see this giant trend coming down. And we've had an uptrend going for roughly 8 years. And if you look back over here, that's kind of the same sort of thing that we had going on then. So there's a lot of symmetry on this chart. So we had the big downtrend for 10 years, a breakout. The uptrend's been going on for 8 years. Here we had 10 years, and now we've been going up for 8 years. So I don't know if it ends here, but just in general, you know, the big trend for the dollar, it does seem to be down. This looks like a topping structure to me. And now we're going to zoom in on these last few years. So getting into the dollar, sorry, this is just, I think I got that chart twice maybe. Let's try this again. There we go. Okay, so looking at the dollar here, what I see is this blue line is support going back to 2015. This 97.5 level that we tried to get through was kind of a support and resistance. It was support in here and resistance in here. And as we fell through here, it was also the 65-week moving average, which from Martin Pring's long-term work, he likes to use a 65-week moving average, which works out to 1/4 of a year exactly, as opposed to, say, the 50-day moving average. And then 6 weeks, or sorry, 6 quarters would be a 65-week moving average. So anyway, we're sitting here well above that, but the real question is, where is this going next? And so when you look at the PPO, it's rolling over, and it's this kind of double top. So it's made a top, came back down, tried to make a higher high, and failed. So we have some negative divergence where the price is higher and the indicator is lower. Moving into the bigger picture, or to just a line chart on the dollar, so taking off the intraday highs and lows or weekly highs and lows, you can see that we've now broken this uptrend. The PPO is confirming that uptrend is broken, and I expect the dollar to move down. Now, the real question is, can it get down below this 93? And if it does, then I would suggest that's going to really change things. But until we break through this 65-week moving average, and it just so happens that it ends up being very close to support, until it gets through there, I think the dollar, you know, we could move down 2 cents and not really change trend too much, but I think a break through the bottom of this support floor would be meaningful. And on the dollar, I just want to go back and highlight one thing here. When you look at this chart, the number of times that the dollar peaks out or bottoms, so I'll call it a reversal, right around year end is high. And back here, you can see it was a year end for 2000, a year end for 2001, a year end for 2002, 2017, it was right on the week. And recently, we've had the dollar roll over late December. So for the people who have followed the weekly market wrap that I do, the weekend wrap, you'll notice that I talk a lot about the dollar kind of failing or changing direction near year end. So that's another reason that I think we are starting to make this big change. Now, moving the dollar around is not an easy thing to do. It is really, really big. But in general, we're sitting here with this head and shoulders structure. We've broken out, and now the question is, do we just go up and come down and this is support and now we turn and head higher? Or does this actually just break down? So you can see that from a lot of conflicting points of view, the long term suggests this thing is ready to break down. The 18-month chart suggests that this thing wants to build a base, and now we're just back testing the neckline and could be heading on our way. This whole area in here from 93 to 97 is going to be a dogfight, and until we get it solved, I think it's going to be harder to pick direction. Okay, so the one thing that I look at a little bit more often is the intraday moves on the US dollar, and the way to do that is to follow it on UUP. We have this uptrend in play here, and we've spent about a week below it now. And so that gives me a little bit more comfort. I don't know if comfort's the right word, that the dollar's probably going to go down. But it wouldn't have to pull back very much to reach this next neckline. So again, there's just so many different ways of interpreting this. But you can see for most of 2018, it was up, and 2017, it was down. And so now here we are at year end, and we were within a couple of days of the high here, and the dollar is starting to reverse. One of the things that you'll also find about the dollar is when the market makes major directional changes. So if I just flip back to, I don't know what happened there. Let me just go here, let's do that point and figure chart while I'm here and do dollar USD. And the reason I want to show this red downsloping trend line means we're on a sell signal on the dollar, and you can see that it doesn't change direction very often, but this was the big one from 2003 to 2011, this downtrend, and then 2011 was the final low, and we uptrended, and now that we've broken below this blue line, we've created this red line. So we've come up to resistance, we're sitting there, and we're getting ready to drop. So let's get back to the chart I was trying to show. But the one thing I would like to say on this US dollar, and I just want to get into, probably this one might help, is that you'll notice that big directional changes on the dollar. So this happened in 2002, which is when the overall equity markets bottomed. This happened in 2008 when obviously we had the big trouble, the financial crisis, and everybody ran to the dollar for the rest of 2008. And then in the March high of 2000 and March low of 2009, the dollar was way up here and it pulled back after that. So everybody just kind of jumped on the bandwagon and started buying around the world, and money flowed out of the dollar after it had raced into it. So the big thing for me is if we're going to have a major change in the equity market, I would expect a major change in the direction of the US dollar. And again, this high here doesn't look like the right place for that, but if you built this as a head and shoulders topping structure, then all of a sudden that kind of marries up that this is the right shoulder, much like this was the right shoulder, and this took a couple of years. This would be almost a 4-year top. But having this structure roll over and this is the right shoulder, then we would suggest that might mark some major change in the markets, positive or negative. We want to be aware of a change in the direction of the dollar. The next thing I want to talk about briefly is when the dollar is going one direction or the other, and you want to diversify your portfolio internationally, two things are important here. And one, as an example, so this above is HEWG, which is the hedged version of German DAX, and this is the unhedged version. And what you can see is when the dollar is falling, so that means the euro is rising. So the euro was rising, and while the euro was rising, so was the German DAX. And in this case, it was up 40%, 39.6%, if you used the unhedged version. So you got the benefit of the currency as well as the stock market going up. Now here we are in the hedged version, and it only went up 20%. So you gave back. You were right to be in Germany, but because the dollar was falling, you would have made a lot more money if you just didn't use a hedge. Conversely, since Germany's been weak for 2018, basically since January is when it made its highs, it's been pulling back. Now, the hedged version only pulled back 22%, whereas the unhedged version, you would have dropped 30%. And the reason for that is the US dollar was rising, so you lost money on the currency exchange. And that's the difference between these two charts. So the benefit that you get when you're using these US dollar ETFs is to make sure if you want to trade internationally, so emerging markets, you also want to look at the hedged version depending on the direction of the dollar. So now that the dollar's broken this uptrend, I'm more of the opinion that you want to be thinking about starting to get into hedged foreign assets. And again, if the stock market was going to start to rise, then we'd want to be in that. Obviously, if the overall market's going down like it did here in 2018, it doesn't matter. The only thing you're helping yourself with is perhaps getting a currency gain if the US dollar was going to fall. So if both stock markets are falling, it might fall less. If both stock markets are rising, then you're probably going to outperform being in a foreign ETF if the dollar is going to fall. So hopefully I've made sense with all that, but I think this chart says it better than verbally. When the dollar's falling, you want to be in the unhedged, and when the dollar's rising, you want to be in the hedged version. So anyway, hopefully that makes sense. Okay. So the next thing I want to cover off is just looking through the euro. And the euro makes up 50% of the dollar. So this is going back 10 years or 12 years here, 07. And what you see is there's this head and shoulders top, which I had shown you the head and shoulders bottom on the US dollar. But we have this very important neckline here that's 4 years long. And so if Europe can start to get going, we could potentially see a big change here where this breaks back above this resistance line. And then we've got some major overhead resistance at this 122 level. And the euro hasn't been around too long, but if we roll out the chart, what you can see is this level was really important even as the euro got started. This is when they actually started to use the cash euro. But this level of the euro at 122 is really significant, much like the 97 level is for the US dollar. So anyway, if we can get through this 120 level, and you can see the big downtrend line from 2008, these two things would mark a major change in the US dollar and in the Eurozone. So we don't know which way it's going to work out. Let's just say that, Britain doesn't go through with Brexit, or Britain does go through with Brexit, or, we have problems with Italy's debt or something like that. We don't know. So all of a sudden, let's say the euro falls. Well, we'd expect the dollar to rocket back up on this news. But right now, the PPO for the euro is set up to start rising, and I'll say it's making a base here, but it's not really substantial. We haven't turned it around, and all of a sudden we're starting to run. It's basically we've paused here. So pretty unsettled looking on the euro. We don't have a clear directional trend. I'll leave the British pound just for now. But the yen has some really nice influences. You can see that when it's on a downtrend, it's pretty important. When it's on an uptrend, it's pretty important. And this line on the yen is the 65-week moving average. And we have just pushed through that line. And, back here, this was a pretty nice place to get long the yen. And then all of a sudden, it was 4 years later when it finally broke through there. And that line became resistance. On the other side, when we finally broke above here, was a big deal. And now we broke below, stayed below, briefly got up there for the first half of the year, went below again, and now we're back up. So I'd say the yen has traded pretty tight for the last 2 years. And obviously you see a lot of similarities to the euro or the US dollar in terms of horizontal support and resistance going on. But the yen has recently just broken through this downtrend line, coming off the highs and back above its 65-week moving average. So the real question is, if the yen starts to accelerate, that would be bullish for gold. And if I just add gold onto the chart here, there we go, price. And we're going to put it behind, behind price. And I want to put it as a solid line and add it as gold. And what you see is pretty much they move lockstep. They're, we're on different scales here, but you can see that as the yen fell, so did the gold. As the yen bottomed, so did gold. Had a brief hill here, and now they started to work. And we've just recently talked about gold breaking out. So if gold is going to continue its breakout, the yen needs to continue its breakout as well. So some people talk about gold as a fear factor or whatever. I don't think it's like that at all. I think a lot of it is it's a different type of currency, and it trades opposite the US dollar, not necessarily one for one because the euro is closer to the US dollar, but the yen and gold trade well together. So that's a pair worth watching. And lastly, as your northern neighbor, maybe I'll just show you the Canadian dollar. And we've been moving pretty much in a tight range here for 3 or 4 years, and recently had an uptrend going on that we broke, but we're still struggling with this major 4-year level. So in general, currencies have traded sideways for the last, call it 2 years, since the not the election, but the commodities bottom in 2016. We've basically gone, really no real progress for a couple of years here. And the real question is, if the yen is going to start to break out and the dollar is going to start to break down, we would expect more fireworks, and that might be more supportive of commodities. So hopefully with just a couple of ideas of why the dollar is so important to your trading, the big picture on the dollar, and again, the chart I want to look at the most on that is this one, where we've got this big giant trend line. And if we get through that, obviously we should all be very focused, because that would be a massive trend change. So that would be back over 100. And then the real question is, if we fall below 90, and of course we're halfway in between as we talk about it, if we fall below 90, then conversely we'd expect another big decision to be made. So as this gets narrower and narrower, we really need to stay focused on what the dollar wants to do here, because it's a major directional indicator for a lot of things, including the equity market, some of the commodities. And even Bitcoin has started to pick up in the last couple of weeks as the dollar has fallen. So last year saw the dollar rise all year, and we saw Bitcoin fall all year. The previous year, Bitcoin was going up all year while the dollar was falling. So maybe it's just a currency pair, and we're seeing that the Bitcoin is just going to trade opposite the dollar in terms of direction. So with that, maybe I'll open it up to Erin and Tom, and we can just talk a little bit about what I mentioned, and then maybe some of your thoughts.
All right. Well, I know I had some questions in the chat room for you, if you want to answer those. Sure. First. Let's see. So are you cross-trading currencies was one of the questions.
I do not trade Forex, mostly because Forex is pretty quick, highly leveraged trading, and for the most part, I trade equities. I'm busy writing blogs and doing videos most of the week. And so I'm not really focused on trading currencies, Forex. I don't really trade that short-term time.
All right, let's see. What do you happen to know if there's a currency hedged India ETF? I don't think there is.
I don't know. I haven't looked for that.
Yeah.
So, yeah.
All right,
and the way to do that is just to go to India, and then just look and see if one of these comes up as a hedged India. Don't see it on that first list.
Nope. All righty. And then let's see. What's your opinion on energy in general, given what's going on with the dollar?
So my opinion is the $42 low held on crude, WTIC. Just go to a 5-year here. And this $42 level held in 16, 17, 18. So as long as the 42 level holds, I think we want to be bullish oil here. I think the Saudis are not going to let it drop back to 25 if they can help it, and because it puts too much pressure on their economy. So while they were trying to slow down the drilling in the Permian with the first move down in 2014, basically they said, we're no longer going to support the dollar or the oil, it'll free float. Well, that was, pretty much the writing on the wall. And until they got back together and said, okay, we're going to start managing the price of oil back up, That kind of made the lows. This was, I think the low actually happened on the options expiration for the futures contract, or for the futures contract expiration in January that day. And then, since then we've had this pullback, but I usually like everything to get above the 50 period moving average. We're not quite there yet, but I think as long as this $42 level holds, I want to be long in oil.
Okay. And then kind of in general, I guess, the question was, we're learning all about the dollar here. How do we use that information to make money on trades?
Okay, and so my point would be, watch the yen if you want to trade gold. If you're trading international ETFs, you want to make sure you know the direction of the dollar to decide whether or not you want to use the hedged version or the unhedged version. If you're going to do emerging market ETF, then you want to know, is that better? Or if the dollar was falling, are you better in EEM as an example, or would you be better to just pick something where you could actually hedge out the currency? And in this case, EEM would be fine, or EWG would be okay as an example. If you thought that market was going to trend higher, then a falling dollar really helps your trade. If you thought the dollar was going higher, then you need to make sure you're in hedged products, because half of your gain will get wiped out by the move in the dollar against your trading position. So as a Canadian, we watch the dollar all the time. Like, that's a big deal for us. And, it's continued to drip lower. Basically, the Canadian dollar follows the price of oil. But so looking at different types of investments, if the Canadian dollar was going to start running up, then maybe you want to start buying whatever, Enbridge as an example. So ENB. So this is a Canadian company, and you can just see it's breaking this downtrend here. It's got a nice little push up. There's not many stocks hitting new 4-month highs right now, but Enbridge is one of them, and it's a pipeline company. But you can see the PPO is just turning up here and making, hopefully a higher low, and we go on to head higher. The full stochastic just moving above 50, Scooter just going above 75. So there's so many things I like about this. But if the Canadian dollar was going to start to rise up, that would also help a U.S. investor use the change in the direction of the dollar by buying Canadian stocks that are listed on the U.S. Stock Exchange.
All right. I have to say I agree with your analysis of the dollar. UUP, I'm looking at that 25.25 level, and it looks like it's going to close a gap by doing that from 2016. So I'm in agreement definitely with the dollar not looking so great here. It's turning down.
It's a pretty impressive, pretty interesting time frame here. We're at the last, I'll call it 10 cents for either a big move out of the long-term trend down, or breaking down again after a big run up for 8 years. So it should be an exciting time to follow the dollar and use it to help you.
Yeah, I would just add a couple things there, Greg. I know one of the questions was whether or not you trade currencies. I would also throw in there, number one, the Forex market opens on Sunday evening, I think Eastern Standard Time, around 5, and doesn't close until 4 on Friday. So if you're in trades, I mean, you could literally be losing money while you're sleeping.
Yeah.
And so that is one thing that I really don't like about trading currencies, is that I don't like that 24/7 part of it, because that would drive me crazy as close as I watch, trades. I don't know if that's one of the factors for you as well, but that would certainly be one for me.
And it's very high leverage. Yeah.
Yeah, and the leverage is just ridiculous. So anybody who does trade currencies, please make sure you understand what you're trading and how much your potential losses are before you ever get started.
I think there's been a lot of rookie traders that were told currencies is an easy way to make money, and what they find out at the end is it's very difficult, because it's one thing to trade short term or see the big downtrend on a long-term chart. But, this flat move for the US dollar for the last 2 or 3 months would just kill you on intraday trading. Just as soon as it breaks support, bounces back up and all that kind of stuff. Lots of whipsaws. So I think currencies has wiped out a lot of rookie trading accounts. It's for the very fastest traders, not learning how to trade.
Exactly. Yeah, you don't want to pay that tuition.
No, that's an expensive one.
Exactly.
Especially with the leverage. Yeah, leverage.
All right, well, here's the poll. So you've got kind of split, but 48% believe the dollar is going to be 94 or lower. So almost half. But then the others are split between, is it going to just remain somewhat flat, or about a quarter say they think it's going back over 100. So got interesting results here.
Yeah.
And so Greg, you're in the lower, down 94 lower category?
Yeah, that's what I think. I think the dollar rolls over here, and I don't know if it's inflation is going to pick up or whatever, but it just feels to me I'm starting to see some stuff moving in the metals and mining that make it look pretty good. So I'm thinking the metals are starting to price in a lower dollar and starting to take off. Charts like BHP and Rio Tinto look pretty good. Vale was breaking out last week. So yeah.
And Erin?
Yes. Well, I like I said, I agree with Greg's analysis, and I've been sort of wishy-washy on the dollar. And now, I mean, my weekly chart, my weekly PMO for UUP just got us a sell signal. So, and we don't get those on the weekly chart that often. So I have to say, yeah, I would look for the dollar to move lower, certainly below 94.
All right, I'm going to go. I'm going with the minority here. I think the dollar's back above 100 by the end of the year.
Ooh.
Wow. So,
yeah, I think right now, the last few months, the dollar struggled, and I think part of that is the whole U.S.-China deal. I just think that right now there's just so much up in the air. I think that's hurting the dollar. But I think and throughout 2018, I think the fact that the S&P 500 performed so much better than many other markets around the world, I think was a testament to the strength of the U.S. economy, at least throughout much of the year. Now, I think that changed a lot in the fourth quarter. And again, I think some of that has to do with what Apple just reported, the fact that, a lot of these companies are really struggling, especially if they've got a lot of exposure over in Asia. And I think all of that, gets resolved at some point in 2019. And I think that the U.S. dollar will benefit from that deal, that trade agreement. So I think the first half of the year, and I've said this before, I think that gold is going to be a pretty good performer, and I think the dollar could continue to struggle near term. I think that'll help a number of the areas and materials in the first 3 to 6 months of the year. But I believe by the end of 2019 that this bull market in the U.S. is in full force. I think the economy strengthens, and I think the dollar goes higher.
Yep. Well, I've just pulled up the monthly chart for the US dollar, and we did get a PMO buy signal at the end of December. So in a very long-term picture, you could certainly, there's a case for that.
There's a reason it's at the thin edge of that wedge. Yep.
Yeah, and I know that, Greg, you had pointed out that trend line. I completely agree with that trend line. If that trend line breaks to the downside, I mean, if you look back over the last 4 years, the dollar indexes, except for the early part of 2018, the dollar indexes had a lot of support between 92 and 94, and that's about where that trend line comes in. So if we were to go back down and take out that level, then I would have to say, hey, the market is telling us something else, and I'd be in total agreement with you.
So,
all right.
All right. Well, it's always a great time having you on the show, Greg. Appreciate it. Again, thank you for last Friday. Thanks for the dollar update and your thoughts there, and gives everybody a lot to think about as we go into 2019.
Okay. Thanks a lot, everybody. Bye-bye.
Indeed.
Appreciate it.
All right. 10 and 10. I believe it's already time. This has been a fast show already. Okay. So I'll pull it up in RRG since we've got them in here all. Not a huge group of them, but that's okay. And then most people will see their stocks. But interesting look, I noticed when we do this, a lot of times our viewers are pretty good about picking out the ones with those northeast directions. A lot of them you can see here turning around in that lagging section. So I think it's interesting how you guys come up with all kinds of different requests, but there are some, similarities. And today it looks like healthcare is the one to watch. So let's go ahead, Tom. TRXC, which happens to be in the healthcare sector, yep. I believe. Yes.
Well, I will say this. TRXC, when you look at it, first of all, it had a massive drop. I mean, when a stock from September 25th goes from $7 down to 260 or 270 by the end of October. I mean, we're talking about 60% reduction in its market cap in 5 weeks. That is a pretty significant haircut. When you look down here at the volume, you can see there was pretty mass exodus really out of the stock over that 5-week period. And if you notice too, that when the PPO started to turn back up, even after we made the cross there above that trigger line and continued moving up, what it really was just a reduction of the downward momentum more than it was any kind of price appreciation to the upside. So you got to be careful sometimes, I think, when you see these positive divergences that develop after a stock has made this kind of move to the downside, because trying to make arguments, especially on this recent low, that you've got some kind of positive momentum going is really a hard argument, in my opinion, when you've got a stock that has fallen from $7 to $2 on the kind of volume that we saw over the last 3 months. So here's what I think. Short term, we broke the trend line. Thank goodness, because if we hadn't, by March, the company would be at zero based on the slope on that trend line. I mean, you've got to break it at some point or else you're going to zero. Here we broke it. That's good news. I circled the volume. I don't think this is a meaningful breakout at this point. We could continue to consolidate for a while. But what I would really like to see is when this stock is really ready to make a run to the upside, I believe you're going to see some money begin to pour into it, similar to what we saw back in May. Here, we had been sideways consolidating for a while. We make the breakout. Look at the volume coming in. That's a good sign of accumulation. This right here, not so much. I think the stock was way oversold. We're getting a little bit of a rally. There's multiple areas of overhead resistance. I think the stock's got a decent chance to make a run for 350, 360, 370. That's about where we've struggled back in November and December. Whether it goes there first or whether it goes back down and tests $2 first, I don't know. I wouldn't trade it personally. I just don't see enough here to encourage me to go long on the stock. But I mean, I like the breakout of the downtrend line. That's the one positive, but I think it's got a lot of work to do. I also circled up here this PPO reading, a -15. That means that your short-term moving average is 15% below the longer-term moving average. That is not easy to do. I know, what was that? There was a stock that Greg and you and I were talking about before the show, Erin. It was a .to stock, and the stock had lost 90% of its value in the last several months, and I can't remember the name of it.
I can't remember the name either.
But I noticed that on that one, the PPO was like at -17 or something. It takes a lot of selling. It takes a huge loss to generate a -15 PPO reading. So when that PPO starts to turn back up, sometimes it's just mathematical certainty more than anything else. So you got to use some common sense, I think, when you're looking at these momentum oscillators. I think I know I've spent a lot of time here, but a lot of teaching moments here. TRXC, obviously in a big downtrend, a lot of volume, a lot of distribution. I'd be careful with it still.
Okay. There's a couple of most populars in the chat room, but one that we looked at recently, I'm going to go ahead and do that one, General Electric, GE, because we did look at that last week, but it's worth a look again.
Yep, and recently when it broke out above 8, and when it cleared 8 on a closing basis, I said watch 9. And here was the breakout at 8. And look where we went to today. Today, the high was 904. We're back to 861. So I think that it's clear this is the trading range to watch for now on GE. Have things improved? Yes, they have improved. Of course, they had improved several times over the last 2 years, only to falter again. So I wouldn't necessarily mistake this improvement for a complete reversal on the chart. If we can consolidate back to the $8 level, hold that rising 20-day moving average, and then come back up with force and get through $9, that is what you want to see from the long perspective. So things have improved with GE. I don't know that it's out of the woods yet. Here's a key resistance level at 9. It's hit it. It's failing so far. Let's see if we can break through.
Okay. Let's see. How about the next one was also popular, and I think mainly because they wanted to hear Greg talk about energy. But what do you think about XLE?
I've been writing about it. I thought that there was more room up to 62 to 64. Let's go back and just do the last couple of years here on the XLE. But you can see all of these lows down here. On this uptrend, we kept going back down to 64. Here was an intraday move into the 62s. You can see the same thing in November. So if I was annotating this at that time, I would have said, hey, great support between 62 and 64. I'm going to draw a line there and then probably right about in here. there's maybe 62.5 to 64. Well, we broke down, a lot of volume, a lot of distribution, very, very oversold. We've now worked our way back into the 50s on the RSI. I think we could still run up into the 62.5, 64 area, but there's a lot of downside now in it. So I think as you get closer and closer to this area, I think the risk is actually to the downside on energy. We're getting a nice bounce. I was looking at crude oil when it was at 42.44. There was a positive divergence. I talked about crude oil going back to $54 a barrel, somewhere in there. And the XLE is going up along with that move in crude oil. But I do think we're probably getting close to the end of this run. And if I was in the XLE, I would be thinking about paring it back as we got a little bit higher here.
All right. Let's see. Next one I'll give you Halliburton in the energy space. HAL, of course.
Yep, HAL. Well, the downtrend clearly is in play. We are getting through the 20, mostly because we're just so oversold. I think the reaction high in this prior breakdown at about $30. Let me shorten the chart just a little bit. But I think that area just above $30 is going to prove to be pretty difficult on Halliburton. And these stocks aren't going to go down forever. They're going to eventually reverse and start to make their way back up. But I think you've got that. I think also the top of gap resistance, if you look at the volume pickup in early December, it was this gap down. So let's just say 30.5 to maybe 31.5. That's the 50 days coming in right there at that area as well. So I think we got maybe a little bit more room to the upside, but selling, very heavy volume. The move back up, not as much. I think we're going to struggle when we get to about 31.5.
Okay. Let's see. One of your favorites, Starbucks.
Well, I think it was in this morning's blog. I talked about consumer discretionary stocks. Believe it or not, yesterday they broke out to a new high relative to the S&P 500. So even though we've been in this horrible down, move, and you expect that the aggressive areas of the market are going to be really weak when the market sells off, and most of them were. Consumer discretionary was not, though. Consumer discretionary has held up relatively well. And like I said, just broke to a new relative high yesterday. So Starbucks is part of that consumer discretionary space. Here was your prior top. We gapped up, broke through it. That area, the price support level, along with the top of gap support, held. We started to move back up again. I actually like Starbucks. I think that it is currently in a range between, I think if the market goes back down, we could see 60 again, 60.5. But I actually think I'd be a buyer of Starbucks on a pullback just because money has been rotating to consumer discretionary. Ultimately, when the market goes higher, I believe Starbucks is going to be one of the leaders in 2019. So I'm a fan.
Okay. Let's see. Next one up, Lilly, LLY.
See if those Starbucks comments get me a free latte. All right, LLY. No, it's not going to get me a free latte, by the way. Eli Lilly, it's in the healthcare space. We talked about a couple months ago, when the market was getting weaker, how, from a relative perspective, how strong healthcare tends to be during not only bear markets, but also this time of the year. December, January, and I think maybe into February. This is a group that tends to do very well. So I think as long as we hold on to, I'm going to say 104 to about 106, as long as this area holds as support, I think Eli Lilly looks really good. We're not far from a 52-week high. So considering what the market's been doing, I think this is a great looking chart. We're consolidating. Look for a breakout above 120. That would be very bullish, especially if volume comes in. In the meantime, any weakness back down below 110, I think, would be an opportunity.
All right. Let's see. Next one, Shopify.
So that's just shop, right?
Mm-hmm.
All right. Shopify. Well, I think part of the problem is we're back to gap resistance. I personally would be shorting the stock if I did anything and using today's intraday high as my stop, because it's had a huge rally. It got right back to a major. There's your gap down. Look at the volume on the gap. This is where all the selling came in and drove this stock from 148 to 130 in 2 days. Now we come back up on much less volume, and here we are. Today's high was 149.82. so far failing to make that breakout. I would be surprised if we make the breakout. I think this is a stock to be shorted, again, with a fairly tight stop. Don't let it, ruin you. But to the downside, I think it could go all the way back down to the 120 area, especially if the market's weak. So I like SHOP, Shopify, on the short side.
All right, let's see. Next one I will give you is, the symbol is R.
Ryder.
Yes.
Ryder rents trucks.
All R's.
Yeah. Let's see here. This one, well, we're at the 50-day. There was your last two reaction highs, so I don't think you're going to see the stock get any higher than that for quite a while, unless the overall market just absolutely takes off. But assuming that the market continues to struggle and we do go lower in the first quarter, I think Ryder is going to have some issues. A lot of selling, a lot of volume to the downside. I think this is just suggesting that the economy has weakened substantially in the fourth quarter. So, yes, we're getting an oversold bounce back to the upside, but when it ends, it could be anywhere from the 50-day all the way up to this 57.5 area. But when it ends, I would look for another trip back down to 45. So I'm not a fan.
Okay, next one up, Berkshire Hathaway, B. So BRK/B.
All right. Oh, wow. Look at the quadruple top up there, 223 area, 224. We've moved back down so far, holding on to support. I'm going to go back a couple of years here. Let's go back 3 years. I mean, overall uptrend, sideways consolidation. I think 185 is your key area of support. So that's where I like the stock mostly on the long side, because if you get it anywhere near 185 and it breaks below that level, you can get out pretty quickly without too much damage. And if it continues to trade in this range from 185 up to almost 225, you got about $40 to the upside. So a little bit more than 20%. And to the downside, like I said, if you get it closer to 185, then I would, you have a pretty good reward to risk setup. Based on where it's trading right now, I don't like it. I just wouldn't trade it. I would wait.
All right, this one's on some interesting support, but I don't like it. Medtronic, MDT.
Well, it is in the healthcare space, and yeah, I don't like that breakdown. I didn't realize it had broken down like that.
Yeah.
Shorten that again now. Yeah, I mean, I'd have to see this thing start to pick back up. Look at the volume on the selling, the failure at the 20-day moving average. I think you've got a couple of things to watch here. One is obviously the falling 20-day moving average, but also that was a key support level. We went below it. We went back up above it, but could not get through that 20-day. And this is one way that my trading has changed over the years, because it used to be that if we'd get back through that price resistance, I would have just exited. I would have said, okay, I was wrong. I've seen so many stocks come through the price resistance, hit the 20-day, and then go back down. So that's a little bit of a head fake getting through that price resistance area. But now that 20-day has dropped, and that is right at about $89. I wouldn't consider the stock until, with volume, it gets back through $89.
All right, and that is 10 in 10. There are the symbols that Tom just annotated. All of those charts, as they were annotated, are going to be in the Market Watchers Live chart list. All you have to do is go to the blogs tab, click on the Market Watchers Live blog, and the link to these charts is right there at the top. And of course, I always put them in the recaps as well. All right, time for our final market update. Let's see what has been going on. It's looking kind of dull to me, actually. All right, here we go. Mostly sideways trading. We had a nice open, came up on a gap for some of these large indexes like the S&P 500 and NASDAQ, but we've pulled back. We're still in positive territory here, but certainly looking a little less excited about a move to the upside. Mid caps are continuing higher, but it looks like they are starting to pause as well. Russell 2000, same, but sitting near intraday highs. TSX, nice big open to the upside, but has pulled back. Again, still staying in positive territory. Treasury yields are up, currently reading 2.712% for TNX. The VIX has fallen. We're looking at a reading at about 20.52. And I think that's going to start making my VIX chart look a lot more interesting. We'll have to see. I'll write about it tonight, I think. UUP, big gap up, but moving mostly sideways. It hit that overhead resistance at about 25.45, those lows that we had on Friday, and then it has started to pull back and try to close this gap that we had form on the open Monday. We've got gold rising at this point, but still in negative territory, reading at 121.56. USO is up, but it has pulled back from intraday highs. Currently, it is reading at $10.41, and TLT is down very slightly, 5 cents at 121.70 right now, moving mostly sideways for TLT. And that's all I have for the final market update. I'm going to pass back to you, Tom.
All right, let's take a look first. I really just wanted to pull up the transports. So here you can see the transports bouncing, getting back up just above the 20-day moving average, but not yet getting back close to where we were at these October lows. That's a problem because transportation, to me, if we are truly, if that was just a little bit of a downside back in December and now everything's fine and we're going to bounce right back up, I would expect transports to do pretty well on this bounce. And if you look at the relative strength, transports versus the S&P 500, they fell apart in December and they're barely bouncing back. So in other words, transports are bouncing, but only to the extent of the S&P, whereas they were rapidly declining versus the S&P in December. So I don't know. The transports worry me, the fact that they're not bouncing back as well as some of the other areas. So I still think the market's going to go down one more time. I mean, maybe I'm wrong. I kind of hope I'm wrong, but I think we could roll over and start to move back to the downside. We shall see. But I would keep an eye on the transports. I do think the transports, if we're truly beginning to strengthen again, I would expect transports to begin to outperform the S&P. So watch for that. Okay, we're going to go into a final segment. This is a new segment we haven't done before, early warning. And of course, about a week ago, we saw what happened when Apple came out with an early warning. Market, didn't like it very much. Apple struggled, and for the most part, continued to struggle. So what I'm going to do is I am going to feed Erin some stocks that I'm going to start off with maybe a handful that just warned today. Now, when I say warning, they're not all bad warnings. Sometimes they're good warnings. They come out and they say, hey, we're going to beat. So we're going to have a few of those as well. So let's start off, Erin. I'm going to feed them to you. You're going to look at them, tell me whether or not you think these are opportunities or whether the charts are showing that there's a warning. And the first one is NVCR, Novacare. And I just want to say Novacare issued upside guidance as to revenues.
All right. I like the chart, so that's good news to hear. I'll just take it real quick and annotate it. Like I said, I think this is such a great opportunity for me to show how to pick out those support and resistance levels. And right now you can see, let's get that skinnier so we can really see. You can see that we've now gotten above, and if I go to the highest close back here, we have just popped above it. We opened right on it, and we are heading back up over that. If you want to go to the intraday high, we still have managed to pop above that from the December move. And, I'm looking at these levels. You can see up here, we still have an opportunity to end up with some overhead resistance at that $38 level. But I do like the look. I mean, we're coming off of this declining trend. We've got, a little bit of a double bottom sitting here. PMO is turned up. It's almost above zero. So I think with, good positive warning, I like this one. This could end up being an opportunity. So I think this is a pretty good chart, actually.
All right. Next one we're going to do is Vivo, VIVO, Meridian Bioscience. This is about a $700 million company. So it's a smaller company. But they actually came out and they said that they see lower Q1 revenues ahead. So a warning to the downside. What do you see?
All right. Yeah, it's pretty ugly right now. I think the only positive when I look at this chart is the fact the PMO is moving into oversold territory. And, of course, that's where you want to find the opportunities, is when you get that turn in oversold territory on the PMO. But look at it right now, it's accelerating downward. And of course, today's price action is just pretty pretty ugly. Let's go ahead though, and I'll pull up some support and resistance. So I'm seeing some lows back here. Of course, the closer low here, the near term low. We've got a high here back in September it matches up to. You can see the high in July and the high back here in January. So I think that it was a very important area of support that needed to be held. It was not. So where are we looking next? So I'm going to come down here. Again, I look for the most touches. You know, that's what I really want to find. So I'm looking over here at the close, the lowest close, and it looks like right around there. And that kind of matches up with these tops that we're seeing back here from April. So that would be the area I'd look for support as far as the next time out. But again, accelerating PMO to the downside, I don't care for it. And it is in the healthcare space, which is good, but
okay, Danaher Corp, DHR. Now, I do want to point out that they are part of the medical equipment group, which as of the end of December actually was setting new highs relative to the S&P, and then the group is on a relative basis weakened. But individually, Danaher said that they see their Q4 core revenue growth above previous guidance, and their adjusted EPS, they're expecting to be at or near the high end of their guidance. So what do you see with DHR?
All right. Well, we're getting ready to hit some really important, an important resistance level there at about $2.50.
Now, DHR.
Oh, okay. Denbury. I'm doing the wrong one. Okay. DHR, of course. There we are. Okay. Let's look at this chart. All right. Well, I got a PMO buy signal right off the bat. I can tell you that that looks pretty good. Look at this area of resistance. It lands on not only these highs back here from January, March, also April, also June, also July. You can see this level has been really difficult for Danaher. Now, of course, we did get back above it. We did manage to get to highs around 110 in October and even in the end of November there. But this is the area to watch, 104. I would be watching to see if we get the breakout. I like this setup though. Notice, ooh, let me point this out because it just appeared to me. We have PMO rising here. Those bottoms are rising, and look what happens to the bottoms that we had here on price. That is a positive divergence. So I would expect to see it break above 104 and try and make that move up to the 110 level. So I do like it. I think there's opportunity.
Okay. And Danaher, by the way, is a $72 billion company. So that one is a pretty good size medical equipment company. All right. Moving on. Here's a $7 billion company in the healthcare space. Jazz Pharmaceuticals, JAZZ, and their story, they see fiscal year 18 revenues at the high end of their range. They announced it this morning. What do you think?
All right. Well, let's see. I think there's some pretty clear areas of resistance right here. Certainly in the shorter term, if I look right in here, that would be an excellent area of resistance here at about 140. Let me skinny it up a little bit here. And then you come back and look where else it lands. It lands at lows in March. It lands near, looks like the lowest close. It's like right on that lowest close back in February. So as you can see, these support and resistance levels, really are kind of a mental thing as well as just looking at a price chart. Not everybody looks at price charts, but they remember where they bought things and they remember where, the highs were, just, memory, emotional memory. And so you do end up a lot of times with these resistance and support areas. PMO is a buy signal right now in very oversold territory, which I like. But this area right here at that 139, 140 level, we need to leapfrog that before I'd feel really comfortable with this as an opportunity. And the reason I say that is that 50-day is so far below the 200-day EMA. That's a bear market configuration. And like I said, this is an area of very strong overhead resistance. But if we can beat that, I think there's a pretty good chance there for Jazz, a good opportunity. And
all right. Cannabis stock's been in the news quite a bit. And Aurora Cannabis, ACB, is about a $5 billion company. They announced that they see their Q2 revenues lower. What do you see on the chart?
All right. Well, this is the weekly, obviously. It's been a wild ride between $4 and $12.50 in 2018. So personally, right off the bat, I can say I would never get into something like this. It's just too volatile for me. That area has been pretty crazy. But let's look at the daily chart and get a more near-term view here. And I will annotate quickly. I see here. So there is a pretty important support level right there. Near term sort of matches up with that August low as well. See near term overhead resistance, I'd say right here at about 625. Coming back, that doesn't have a lot of touches as far as tops and bottoms. So, you know, I think that's a pretty decent area to look for a move to the upside. But this PMO has been really flat. We're not getting a lot of action. I see some momentum here in the thumbnail, of course, off the low. But right now, I'm not that impressed with it. I think you could see that move up to the 625 area. But again, this would be an area there's just, it's a little too volatile for my blood. So maybe an opportunity, but honestly, I don't think so. I don't think I would do it.
All right. Sounds good. This one is just one that floors me here. Illumina, ILMN. Last night at the JP Morgan Healthcare Conference, they guided their Q4 revenue higher, and they also guided their fiscal year 19 earnings per share higher. It's part of that biotech space, and up until about a month ago, this was one of the better stocks in biotechs, but its relative performance versus its biotech peers has really come under some pressure in the last 4 weeks or so. And with this good news, you can see the reaction. It's down. What do you think of Illumina?
All right. Well, this is very interesting, isn't it? You know, I want to take a peek here at the rising trend in the short term just to see what's going on here. And it's very short term, but there we go. And you can see right now, today, we're getting a break. And of course, this is a short-term break, but it is trading. It opened and is trading, you know, right around that area. Well, of course, you can see it about 285. I'm sorry. So, you know, we broke down below that, but I think the rising trend is still intact. I mean, you can even move it this way. I mean, that's a rising trend channel to me, even though we had that touch below it. This is a little bit concerning, is that PMO topping below its signal line. But, you know, when you have a 5.25% decline, the PMO is going to turn down. You can see it's just ticking lower. The 50 is above the 200. If we can get above that 200-day EMA and continue in this rising trend, I think there is some opportunity here on Illumina. But wow, how strange, you know, positive news, and yet the stock falls.
Yeah, that one is crazy. I was really struggling seeing, you know, because this has been one of the top performers in biotech for a while. It's got a really nice long-term chart, as you're showing right there, and it probably is just consolidating, you know, after the huge move that it had back in 2018. But yeah, it's one of those things where I guess maybe so much good news was priced in, even the you know, them coming out and raising guidance wasn't enough to jumpstart the stock from this level. That's a little bit of a warning, I would say. Wouldn't you agree?
I actually do. And then look at this. Too bad Carl isn't here, because I know he is the parabola dude. Okay, let me go ahead. I got to get this to work here. Parabola. Yeah, so this is a parabolic move here. Let's see if
Hey, my kids used to.
I don't know why this. Let's start over again, because I really do want to point this out. I think it's interesting to see. I have no idea. That was really strange. Okay. All right, there we go. Now there's that move. So this is a parabolic move to me. And again, these usually break down very quickly. And of course, you know, we saw the market do the same, you know, move in this parabolic fashion, and we got the breakdown. Now, typically they happen fast out of a parabola or a parabolic move, and it moves down to the last area of the basing pattern. And, you know, really Illumina could make a fall, I would say, all the way back down to this 240 level at that high, if you're going to go by that parabolic. And you can see also PMO sell signal on that weekly chart. So in the intermediate term, I definitely am not a fan of Illumina.
Yeah, I agree with you. I was looking at that 240 level as well. I mean, you know, a company that's been that solid for so long, raising guidance and the market doesn't seem to care. That could be a problem.
It's pretty messy.
Yep. All right, a couple more that I'm going to give you now. These companies haven't said anything that I'm aware of, but their charts are either mixed or maybe sending a message. So the first one I want you to take a look at is Netflix.
All right.
What do you think?
Okay. What is your mess? You're going to tell me what you think the message is after this, right?
No, I mean,
No.
I'm kind of confused by it, to be honest, but I want to see what you think.
All right. Well, first of all, let's go get our trusty support and resistance line and see what is going on here. So I'm just looking across here. So there is the shorter term resistance that we got over at 300. And I'm looking at the matching areas. You could say we got some highs there in February, the lows back here in April, the low in August. So I think this is a pretty good level to look at as far as support and resistance. And we got the breakout here yesterday off of a really nice move to the upside. I think of the FANG stocks, this is probably one of the stronger ones, but I also feel like it's subject to the winds of the market a lot more than some of the others. I mean, it does actually form the wind a lot of times. So it looks good right now, though. You've got the PMO buy signal. It's almost in positive territory. This is the area I would watch, though, that 340 level. That comes in at the top we had back there in April. And in terms of a zone, a resistance zone, I would also match it up here to that November top. So you can see right here how that level, maybe even at 335, could be a problem. I'd be watching that closely. And if we do get that breakout, we could see some opportunity here. The problem I have is that I am still very bearish on the market in general. And like I said, this one does travel with it. So.
Yeah, the other thing I was looking at on Netflix, maybe if you pull up a weekly chart.
Here we are.
Because the other, when I first looked at the daily chart and I saw it, doing as well it's been doing, I was like, okay, let's see if it can get through the 20-week moving average. Well, I looked and it already has gone through the 20-week moving average. But yeah, that downtrend line I think is definitely worth keeping an eye on. And that intra-week candle, we are above the 20-week, but we have till Friday before that weekly candle prints. So I believe that, you want to kind of keep an eye on it. This is one, and actually, if you take that same slope that you just did on the lows there and grab it and drag it, I don't know if you know how to do.
Yeah, of course.
Yeah, drag it over to to that high where we are right now is almost setting up a channel. So I would be careful if Netflix reverses off of where it is right now by the end of the week if it starts to roll back over again, because you could be in a steep channel that might go down one more time. So be careful with Netflix.
Yeah, and I don't talk about them very often, but you can see that we do have a kind of a horn, an expanding pattern. I know there's a different word for it. I can't think of it right now. But you're getting that expansion of the, instead of a wedge, it's getting more and more volatile is what that's telling you. And generally, of course, volatility we do tend to want to stay away from. I think it is good news, though, to see the PMO turning up right now at the zero line, because typically these tend to be pretty good signals before a decent rally. So I think that's positive. But
okay, well, let's go ahead and get a summary of the stocks that we just looked at here, because there were several of them. The other two, Aon and WFC, Wells Fargo, were two that just look like they've been beaten up a little bit. Maybe we'll talk about them another time. But some of these companies that have been beaten up, I would not be surprised if we get warnings from them, or when they report their results, if those results come up short. That's what I'll be looking for. But
yeah,
we shall see.
Yeah, somebody just asked too in the chat room a little while ago, is there a way to know why a resistance or support line occurs, like fundamentals? Is it knowable? To me, I think support and resistance happens because of that muscle memory more than anything else. Money makers, individual investors, we all know where we purchase things. And, so typically that's what you'll see.
Yep. Dow Jones currently up 187 as we come down to the end of this show today. I want to thank everybody for being with us. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everyone. We'll see you back here tomorrow. Happy trading. you.